Hi, Joe Cantu here, and I wanted to talk a little bit about the U.S. economy, the pulse of the real economy, of what's going on out there in the United States. And the reason I think this video is timely is because if you look at the news media, they don't know where the stock market's going. They think it's going sideways. Now, my belief is the stock market's going up. Now, I've been saying that for 3 years, and I sound a little bit like a broken record, but the reality is I'm going to show you proof in the real economic numbers here of why the market is going down or what's caused it to go down, and then why I think the market is going to continue to rise, and it's going to rise, I think, fairly strong. So let's get started. And I just want to say that Ronald Liston and I, we talk, every week, sometimes for hours in the morning, about analyzing the economy, analyzing economic indicators, and we talk about the pulse of the market and where's the market going.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager.
So in our discussions, one of the things we look at every morning, we look at all the economic indicators and what direction. Now, the biggest story that we've had in this last week or so is that the U.S. GDP has reported. Now, the U.S. GDP, gross domestic product, is the granddaddy of all economic indicators. The U.S. GDP report is the report card, as I wrote down here. It's the report card for the economy. The U.S. GDP includes all underlying economic indicators. That's what it includes. Now, if you take a look at this chart, it shows that the GDP faltered during the 2008 financial crisis. There's Y2K right there. 1990 was the savings and loan crisis. And then 1987 was, of course, the stock market crash. Anyway, so this is going all the way back to 1950. But look at the last 10 years of the gross domestic product. Now, if you look at the last 10 years, you can see that the GDP is moving up after the COVID incident. And this chart right here shows that COVID incident. But since 2020, moving into 2021, 22, 23, it's moving up. The gross domestic product's moving up. That's the report card. That's why I know the stock market's going higher. It's not a guess. It's not, I know that it's down right now, and the actual S&P is negative for the year. The equal weight S&P is negative. If you take out the top 7 stocks of the S&P 500, that's crazy. But yeah, if you take out the top 7 stocks of the S&P, 493 stocks are negative for the year. But despite it being negative for the year, I know the market's going up. It's not a guess. I know it is. I just don't know when or what's going to be the catalyst. But I feel like we may be very close to the catalyst, and I'll tell you why at the end of this presentation. So now let's look at GDP for the last 5 years. So this past week, we had GDP report, and it was 4.9%. That's a huge number. And what's crazy is they were predicting a recession in 2022. I said we weren't going to have one. They were predicting a recession in early 2023. I said we weren't going to have one. And here we go with a 4.9% number. That is a huge number. And then the market's, selling off. It's like, when are analysts or money managers going to finally look at good news as being good news? But that's good news. Now, what's even more interesting is what was the GDP last year for the same quarter? It was 2.1%. So that GDP, the gross domestic product, our economy, which includes, under that number, under the GDP number, you have housing, you have employment, you have savings, you have earnings, you have I mean, it's everything. It's everything included. Retail sales, manufacturing, industrial, producer price index. It's all of them combined into the GDP number. That's why it's the granddaddy of all, and that's the report. It's doubled in value, doubled in terms of performance. Actually, it's not value, but in terms of performance for the United States, and I think it's going higher. Now, in order to get a recession, it's 2 negative quarters of GDP. So I think that the gross domestic product is going to go from 4.9 to below 0 in the next quarter? No, I don't. Or the first quarter of next year? No, I don't. I think it's going higher. But I'm going to show you in these charts one of the reasons the markets has been selling off and what's causing it to sell off. But at some point, people are going to have to look at these numbers and say good news is good news. Now let's move on a little further. So let's just look at the numbers, the real numbers. So Ronald and I, we talk all the time, and again, we talk about how these numbers come out and the market sells down. But look at industrial production. So industrial production is currently moving up. Look at manufacturing sales. You know, people talk about, oh, well, you know, the manufacturers and the sales are not doing that well. Hey, give me a break. That's not true. These are the real numbers. Manufacturing sales are currently moving up. Now, was there a little dip right there in July 2022 and then moving back up to 23? Yeah, but it is moving up. Manufacturing sales is moving up. Now I'm going to show you what has caused the market to sell off. Again, if you remember many of my videos, I've been saying that these economists who are in their 40s and money managers running things, they haven't been through a rising rate environment. I have. I've been through several. And so in their minds, when interest rates go up, it causes lower profit margins because they have to pay higher prices for goods. So they think that in general that sales are going to drop off. Well, sales haven't dropped off, and I'll show you that in just a second. So this is the economic forecast. So let's look at this chart. So economists, they send them a survey. And these are the major economists who work for these major companies who put out these research reports, and they send them to the money managers. So they have predicted over the last 5 years, analysts forecast, quote, it's a guess, but look at that. They have forecasted that sales revenue growth will be decreasing. And if you look at the time frame of years for 2021, 2022, 23, a little bump in 22, but they're predicting, and now look at this number way down here. So their prediction for sales growth is way, way low. If you remember, almost everybody was saying by the end of 2023 we're going into recession. We're not. That's not materialized at all. It's been, quite frankly, just the opposite. Here's actual retail sales. Let me just scroll down. And Ronald and I, again, we scratch our heads when we see this. Retail sales, actual 5 years, boom, moving up. That's the real number. It's not their number. Look how low that number is. That's what they're predicting. Nope, that's not what it is. Again, they've not been through a place with rising interest rates. You know, I have. Now, if you take out autos, some people say, okay, well, you know, take out autos because, you know, they're on strike and some other things like that. So here's the numbers the last 5 years. It's moving up too. Even if you take out autos, it's moving up. You know, some people said, oh, we've had a lot of Tesla sales, so that's driving up the retail sales. Okay, take out the autos, take out Tesla. Here's the numbers. It's moving up. Now, let me show you another. So that was number one. First off, the analysts and economists are predicting a lower forecast. These are the same people predicting that we're moving into recession, which I've been saying for 3 years we haven't, and you know, primarily because of employment. And so now they put out another. This is another report that's running side by side with them, is the employment forecast. This is their economic forecast survey of employment. Notice how dismal it looks, and notice that they're predicting recession and they're predicting falling employment. This is their survey that they've put out. And then look at 2023 July. That chart is way down there. If you look at that direction, it's way, way down. What is the actual number? Again, this is why I'm showing you this video. What is the real number of employment? Here's the chart. Boom! There it is. Actual results of real employment currently moving up. It's phenomenal. And in my head, Joe Cantu, it's because of this employment number that I keep saying that, it's impossible to move into a recessionary period. First, if you remember last year, when second quarter, they started talking about, it may be, we're maybe not going into recession, but it may be just a mild recession. There's no recession. Zero. Not with a 4.9% GDP. Doubled of what it was the year prior of 2.1 in the same quarter. Now, some people have said, oh, yeah, but, if you take, but women aren't going back to work. That number is skewed. So I just, for kicks, I looked it up. This is the Federal Reserve data right here we're looking at. So employment for women in the workforce, it's moving up even at a higher rate in the last 5 years, after COVID. And if you look at the chart before that, it was moving up really high, and then COVID fell. Everybody had to stay home. Now it's recovering. Now it's moving up even at a greater arc than regular employment. So now the last thing is I want to talk about is business goods inventory, and then at the end I'm going to tell you about where the market's going, in my opinion. So one of the things I look at, and Ronald and I talk about inventories, what's going on in the businesses. If you're running a business and you think that business is going to be slow, then you will reduce your inventories. If you remember during COVID, you couldn't get anything. I ordered a refrigerator, and it took me months to get the refrigerator because nobody had them in stock because everybody was at home and nobody was manufacturing. So now they're back manufacturing, and so the business inventories are good and they're strong, and they've accelerated. And so you can see at the very tail end of this thing has a little whip up on it, has a little bit of a whip up on the inventories. So that tells me that they're expecting good sales moving forward. Now, let's talk about the market and the Middle East. I'll talk about, address that in just a moment. So, earnings is really what drives the stock market. It really does. Microsoft came out with fantastic numbers in the past couple of weeks. So, right now, we're in an earnings season. And it seems like during earnings season, the market goes up and then it pulls back. But this earnings season is kind of pulled back a little bit. Why? I don't really know, because the numbers have been pretty good. So far, 49% of the S&P 500, so almost 50%, but 49% of the companies have reported as of this Friday. Of that, 78% have beat numbers and have had, quote, an earnings surprise of stronger numbers. Also, many were predicting that this quarter there would just be negative S&P earnings. Wrong again. There is a 2.7% increase in earnings growth of the S&P 500. Now, next quarter they're predicting a little bit of slowdown. I don't think so. We're going into Christmas season, and you're going to have high sales in Christmas. And then likewise, let's talk about one of the reasons that the fourth quarter is typically so good for the market is that in November, if you remember, that's when pension assets are contributed to foreign countries. They do it in foreign companies in foreign countries. They do it once a year. They do it in November, a contribution, and then that money has to go in and buy stocks in the market. Whereas the United States, they normally contribute on a quarterly basis. So typically, November and December are two of the best months of the year. Now, the first 2 weeks in December are always a little iffy, but then the last 2 weeks, if you remember, you get capital gain reinvestment and dividend reinvestment, the one-time payout of the capital gains. And because that happens between December the 15th, 16th, 17th, 18th, every day at different mutual fund companies, they pay out those capital gains. They call that the Santa Claus rally because it happens over during Christmas. Now, some years the Santa Claus rally is not very strong. Other years it may be. I think this year it's going to be a strong year. That's what I think. Anyway, so if you remember the numbers, if the number is above 70, 72, 73, roughly in that range, that's kind of a secret number of the S&P beating the numbers. The stock market does pretty well. It's 78% already. And so that, again, we're only half through, but I think it's going to continue. Now, let's talk about another reason that Joe Cantu and Ronald Liston, that we think the market's going to go higher. Number one, you have now seen the real numbers. Forget what they're saying on TV. You can listen to it, but they don't understand. They're not looking at the real numbers. I just showed you the real numbers. I also showed you what analysts and economists have predicted, and they, in essence, have caused the market to sell off. So because of them, that's why you had a negative market over the last 3 years. But yet, if you look at the numbers, they're all going up despite rising interest rates. They said that rising interest rates would slow down housing. Guess what? It hasn't. It hasn't slowed down housing. Matter of fact, real estate is one of the sweet spots in our economy. It's millennials who want to move into these houses, and there's just not enough housing in the United States, and that's why building is so strong. Building on new houses is so strong. So now let's look at the price-earnings ratio. This is one of the reasons that I know the stock market is going higher. I don't know when, but I know it is going higher. My prediction is this November, December, maybe any day now, we've kind of hit a bottom. But the S&P 500 normally trades at around about an 18.5%, 19% PE ratio, price to earnings. So what is it right now? Right now it's about 17. I think the actual number is about 17.1 as of Friday. But what does that number indicate? Well, the average PE ratio for the 10-year average for the S&P 500 is 17.5. So it's below the 10-year. So that means to me that number is going to rebound and go back up. It's kind of like if you looked at the market and you see it moving down and up and down and up, you kind of know that you've hit a bottom at a trough, and then it's going to move up and recover. Well, I think we're down at the bottom at the trough. The other thing is the 5-year average is 18.5. Well, we're way off that number. We're way, way off that number. So that's the 5-year average. So I really believe we're kind of at a trough in the market, and then it's just going to take off much higher. And again, at some point, all of these people have to say that good news is good news. Now, let me just talk about let me just make fun of some of these analysts who have just not gotten it right and they're scratching their head. So I heard one person say, "Oh, well, the good number just indicates that this was a GDP number of 4.9. How everybody was just like blown away with that number." And they said, "Oh, well, that shows that it proves that what we already knew, that the consumer has gone on a spending spree in Q3. I mean, that's the most ridiculous comment I've heard. Or another guy said, "Well, he's talking about the economy. Yeah, it was a 4.9, but, that's a backwards looking number." Hey, every economic indicator coming out is a backwards looking number. So that doesn't make any sense whatsoever. So when you look at housing, and you look at producer price index or capacity utilization or retail sales or whatever you're looking at, it's always a backwards looking number. But that is how we determine how well our economy is doing, and that's how we make forecasts. So Joe Cantu and Ronald Liston, we both think the market's going higher, and it's going to recover off these lows. And we're hoping that it occurs, pretty quick, and we have a good, last 2 months. That's our expectations. But again, I wanted to put this video out and show you the real numbers, so the real pulse of the economy. Oh, I promised you I would talk about the Middle East. So let me talk about that just for a moment. So it was predicted that because of the Middle East situation, that it would affect oil, and reality is that it caused it. The perception of the war caused some of the oil service stocks to bounce up and oil to move up a little bit. I think it's trading in the low 80s right now, WTI, West Texas Intermediate, but it hasn't. And somebody's talking about, okay, if they block the Strait of Hormuz or whatever, on that, these oil companies, they have other means to get oil out and deliver it. But my belief is that it's not. Now so I don't really think that that is going to affect, the production of oil. Now, what has affected it, I guess, is that I understand that our president has used up many of the reserves to keep prices down. It did work. I mean, he did move oil from $5 a barrel down to got to $5 a gallon. Sorry, down to $3. But now he's used it up. So yes, we could see higher oil prices, higher prices at the pump, and but yeah, I mean, do I think it's going to affect business flow? And that it'll affect it a little bit. I mean, everything affects business, but not by any incremental degree to cause sales to drop off. I mean, right now you can see the numbers. And the other thing to point out, if you look at that employment number, if people are going back to work and there's more people working, that causes more people to have money to spend. That causes more products to be sold, whether they're refrigerators, jet skis, automobiles, going out to restaurants. I mean, look at the restaurants. Are they full? Are they packed? Do you have to wait in line? Look at flying. Look at transportation. So I will say that the transportation index is a kind of a telltale sign which direction the market is going. So, you can be looking at that. But in general, I don't think the Middle East conflict is going to, it actually will help the economy, because now we have to, make more bullets and beans and tanks and, all those things. So it helps businesses, especially in the defense contracting arena, for business production, so to speak. So my belief, again, in conclusion, and Ronald and I's belief, both of our beliefs, is we think the market's going higher. And we think it's at a trough. And I wanted, again, to show you the real numbers so you can see it with your own eyes where things are going. This is the Federal Reserve data. This data comes from the Federal Reserve. These are the real numbers out there, and it is the pulse of the economy. Thanks for watching.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager. Over 10 years ago, he created Cantu Tactical Wealth Management, which actively balances and selects investments based on a tactical approach rather than the traditional strategic management method. Instead of the buy and hold philosophy, he believes in the pursuit of finding investments showing momentum, performance regardless of the direction of the market. His experience includes IRA accounts, 401k rollovers, trusts, endowments, defined benefit plans, 403bs, and 401k plans. Additionally, he served as a night college instructor for seniors, teaching high net worth retirement and estate planning for 14 years. Podcast views and personal opinions are for educational and entertainment purposes only and does not constitute a recommendation. Investing has risk of loss, and you should consult with your own advisors for any financial decisions. Cantu Tactical Wealth Management is a fiduciary, registered investment advisory firm in the states of California, Florida, Georgia, and Texas, providing pure independent advice and money management.